Hi everyone, welcome. I'm going to give some idea on the VIX or the volatility index in today's video. Uh, it gives significant inputs to the investors whether the market is stable or not. What is the fear that the investors have in the market with respect to if the market is going to go down further or it's going to go up or it will trade in a certain range, right? So this is very important for us, even for retail traders to know, because we should definitely invest at the right time. We should not be investing in a volatile market where the returns are not good, right? And you don't have any sense of how much you are going to make or lose, right? Because there is so much unpredictability in the market. So if you see, I am on the Thinkorswim platform right now, and I'm typing VIX, which is the VIX. Now, if you see, the name is CBOE Market Volatility Index. CBOE is for Chicago Board of Exchange. So this index is traded on the Chicago Exchange, and it is called as the Volatility Index, right? What it means is uh, it gives some inputs to us with respect to if the market is stable or not, right? So any values of this index below 20s or below 90s, it means that the market is okay, it is stable, and the fear is less, right, amongst the investors. If the value of this VIX increases significantly, if you see during the COVID time, before the COVID time, how what the values of the index were, it was trading in a certain range from 8 to 20. If you see, this is the range in which it was trading through 2020. And I think when COVID picked up, I think during March of 2020 or Feb of 2020, it started rising, right? So every time if you see, I will zoom in a little bit. Every time if you see the price of this index starts rising, it was like 13 or 14 uh, on Feb 24th, right? If it starts rising significantly from its average value of 15 or 16 in the previous 5 or 10 years, right? So you can understand that the people or the investors in the market are worried. They are concerned and they have more fear with respect to something is going to happen in the market, if you see. So from Feb till March 16th, if you see, it had its high of 85 on March 16th. So somebody might have some idea. I'm not sure why we saw investors investing into this volatility index and the value was rising for a month or so. So since February, mid-February until mid-March, and that is the time frame when COVID was supposed to come in, right? We were getting news from all over the world about the COVID is spreading, and there was a news where people were dying in China, right, due to COVID. During this time, the volatility index value started rising. It rose from 14 to 85. It never happened in the previous years, if you see. If we have a look at the chart. So what I'm trying to say is when the value of this index starts rising, which means that the fear amongst the investors starts rising, right? The fear of the market collapse, the fear of some activity going to impact the markets, the fear that the markets are going to go down significantly, right? That happens, correct? Now, if you look at the SPX, our mother of all the indexes, the main index in the US during the same time, you saw from Feb till March, the market started collapsing during the same time frame, if you know, right? So, as we are looking at the previous chart for VIX, the volatility index was 14 here around 17th of February. Market started crashing a little bit. So people or the investors started buying VIX, and that's the reason the value of VIX was going high, right? Now, what you can interpret from this is you can sometimes predict if there is a major turnover, a major drawdown coming in the market, going to be coming in soon by looking at this index. I will go again and type in VIX for VIX. If this value value of this index starts rising, this is parabolic value. I mean, I'm not sure how we would have predicted, but again, if you see here, we are in the same state and the value of this index started rising from 16 to 21, right? It is 21.7 right now. It gives you some idea that the people are again, the investors or institutions or hedge funds or mutual funds, they are again started fearing that the market is going to go down or something major is going to impact the markets. Now, it could be the recession fears going into 2024. It could be the inflation issue or concerns. It could be the Fed is going to raise the rates again in November meeting. But this is what is telling me as this index is going up now, I see something is going to happen to the market. I cannot predict, but I am bearish right now, and I think the market is going to go down further. Uh, if you look at here, there is a red candle, and exponential moving averages are crossing each other and implying that there is a downturn to the market probably coming in. But this is just my analysis, right? Nobody can predict the market 100%, but we can get some idea. Now, what you should do if you are seeing this index rising, right? What approach should you take? VIX is also used for hedging purposes, right? So if you are long in the market, if you have stocks, you have bought stocks or bought call options, and you are thinking long term, if you have some good majority of stocks like Tesla, Microsoft, Google, the stocks or companies which you trust, and if you think they are going to go up in the future, you don't want to sell them now. That is your thinking, and you are slightly bullish, right, in the long term. You can use this index for hedging. How can you hedge your portfolio? You know when the market falls, the VIX rises or vice versa, right? So the volatility index is always, it works inversely proportional to the market. If it rises, market will fall. If VIX falls, market will rise, something like that, right? That relationship. So what ideally you can do is going out 6 months or 12 months, you can buy uh, options for VIX if you consider that the market is going to go down, VIX is going to rise significantly, correct? And if that happens, you can buy call options for VIX out of the money. If you see right now, I'm on the options chain, and do you see the volume? 29,000 for 60s. Do you see the open interest, the number of contracts open for VIX index for 17th of January? 45, 47.5 strikes, right? So you can buy these out of the money calls, and then you can sell some of the puts which are out of the money. Like let's say, so if we sell the 15 put and we think that the VIX is not going to go below 15 by January 17th, 2024, you can buy the 45 or 40 calls for January. So you are reducing the risk of your portfolio, and you are also reducing the cost of your hedging. So if you are buying one call for $109, you are also selling the $20. So uh, approximately in $90 you are getting a call option, right? Now it depends on the number of stocks you have or what the portfolio looks like for you. You have to do multiple of them. Just not one will not work. So you might have to buy of tens or twenties of these calls, right? And sell tens or twenties of these puts in the portfolio to hedge your portfolio, right? So VIX is also used to hedge the portfolio. So we can do puts or calls options depending on what your market opinion is. If you are bullish, you think the market is going to go up, VIX will go down, so buy puts. If you are bearish, if the market is going to go down, the VIX is going to shoot up, right? How it went during the COVID time, and that is one of the ways where you can protect your portfolio. So thank you guys for looking at my video. If you like my channel, subscribe for upcoming videos, and I appreciate your support, all of you. Thank you. Bye.